Welcome, and thank you for joining us. You're listening to The Educated Investor. On this podcast, we'll not only cover current events, but also ideas to help you possibly maximize your Social Security benefits, manage your taxes, and overall become a more educated investor. And now, here's your host, Jerry Blakely.
Well, hello, and thank you for joining us for today's episode of The Educated Investor with Householder Group. I'm Jerry Blakely, your host, and on this episode, we'll be talking about mid-year market outlook as we enter August of 2022. Well, today we have Dr. Quincy Krosby, the Chief Equity Strategist with LPL Financial, joining us. And Quincy studied at the London School of Economics, where she earned her master's and doctorate degrees. She's frequently quoted on financial press, and she appears often on business television. I asked Quincy to join us today to provide us with a perspective on what's going on with the markets. And I'm excited to welcome you, Quincy. Thank you for being here today.
Thank you, Jerry. Thank the entire team at Householder. I appreciate it. Appreciate the invitation. Thank you.
And I want to be sure that everybody knows that you asked us to call you Quincy, not Dr. Krosby. You said that you want to explain these very kind of complicated things in economics and equities and things like that, as if you're talking to your friends or to your family around the coffee table or around the breakfast table. So I hope you've got your coffee with you.
I do. If you had the video on, you'd see I switched to tea because after 6 a.m, if I keep drinking coffee, I'd never let you off this call.
Okay, well, you've got a lot to say. I want to go ahead and get started. And I'd like to start with a brief overview of what's going on in the markets right now. What's going on with the markets and the economy right now? Just briefly, and we'll get into more specifics.
Yeah, absolutely. I just want to preface what I say by telling everybody that the economy and the market is not the same. Sometimes it looks like the same, sometimes it actually is, but the fact is they're different. And you could see it actually in last week's jump up in the market. It was a fantastic move in the market, despite that we had 2 quarters of negative growth. Many folks say, Quincy, that is a definition of a recession. I will call it a technical recession. We'll go over that. But we also had the Fed meeting. Chairman Powell made it clear there will be more rate hikes if inflation doesn't come down in a meaningful way. And the market zoomed up. So what was that all about? How about that we entered the earnings season? Folks, we always look back, obviously. We said we entered the second quarter earnings season very, very pessimistic. Analysts said it is going to be dreadful. Guidance is going to be awful. And guidance is important because the market looks ahead. So whatever the companies tell us, obviously they're telling us what they see, what their clients see, what their customers see. And what is particularly interesting in last week's move in the market, and it was profound, is that some of the companies had problems. But if they weren't as bad as what expectations were going into the earnings call, the market said, that's fine, as long as the guidance had a smidgen of optimism. Also, you know this, Jerry, last week was big tech week, wasn't it? It was right. All of those big names that we live with. Sometimes I think we can't live without. And yes, I'm talking to you, Apple. It was important because Amazon and Apple did very well, despite all of the issues with the supply chain, despite so many issues with, cost rising for their customers. Apple had tremendously good guidance, as did Amazon. One thing I want everyone to know about those 2 companies, their major market are folks that have middle income to higher income levels of wages. Mm-hmm. And we know that cohort is doing well. In fact, MasterCard told us they are doing well, that they're spending, whereas MasterCard said that lower wage earners are not doing as well in terms of spending. They have to use more of their income for food, for transportation and rent. Okay. So that was very good news. And may I wrap it up for one thing, because this is it. The top 20% of earners in America are responsible for approximately 40% of retail sales. That tells you why those two companies could have actually strong performance, because their market is still, they have jobs and they're willing to spend money.
So it's possible to have the economy in a recession, but have the stock market going up, a bull market. Is that possible?
Well, it is possible, especially if we don't go into a deeper recession. This is the big question. And you get, how do I say this? In economics, as somebody who has studied for the ministry, it reminds me of theology. I mean, heaven forbid you say something that deviates from what people think, that, they think you're a heretic about economic thoughts, right? So yes, and also I'm sure that folks listening saw this. Senator Ted Cruz had a video of none other than President Clinton when he was president. He was asked, what does 2 quarters of negative growth mean? He didn't waste a second. He said, it means a recession. There's a debate. And you know what? How do I say it? I started on a trading floor in New York, and folks there, have a wicked sense of humor. And what they would say is it's a recession if you lost your job, but not your neighbor lost his job, but if you lost your job. So very wicked. But,
then you're in a recession if you lost your own job.
Yes, but here's the thing. The larger picture of a recession, the larger definition of a recession, actually is very much based on how the labor market is doing, how retail sales are doing, and how private wealth, so to speak, a personal income, how that is. The labor market remains intact. Yes, it's weakening a bit, and as the cost of capital goes up, as rates rise, we expect that we will probably see more unemployment. But what we are seeing is that when folks lose their jobs, because we are starting to see that they are getting jobs very quickly, because there's initial unemployment claims. That's when I lose my job. And if I stay unemployed, they're called continuing claims. And those are not moving high at all at this point. So what we're watching very closely are headlines about companies laying off people, hiring freezes, and particularly at this point, with those whom we call office workers, we call them white collar workers. And the reason is, if they stop spending, guess what? Who's going to be left to spend? My husband says it'll be me, but even I will be very, very careful.
That would be indicative of the recession getting worse or not, those things.
Yes.
So can you explain to our listeners the correlation between the concept of when there's inflation, then the chairman of the Fed, I guess Powell right now is his name. I know it changes every few months, but it starts raising interest rates. What's the correlation between interest rates and inflation? We know the prices are going up like crazy, so why are interest rates going up also? I mean, I think I know the answer, but I want to hear what your perspective is.
Well, the problem that the Fed faced is, one, you've got issues with the supply chain. Right? Whether China is slowed down, the factories are still shut in different parts of the country. That's one thing. Also, we had problems with shipping. It's actually easing, because we are getting reports that containers are actually being loaded and unloaded. This is very good news. But what happens when the supply chain challenges stay intact? You don't get the inventory that you need. You don't get the parts that you need. And therefore, anything you can get, just ask me about my refrigerator. I thought it was American. It has an American name, but there's a part that comes from China. Guess what? The price went up for that refrigerator. Oh. You would have thought I bought a European fancy, who knows, whatever they do. I just want a refrigerator, folks. I just want my food to be cold and the ice to be I don't even use the machine. I just put old-fashioned ice cubes. But the prices have gone up. And that has exacerbated the inflation. Here's the other thing. Companies that raise their prices, we all know this, they try to pass it along to us. So not only is there less of the whatever you bought, say it's chips, less of that in the bag, but the price has gone up. And so far, we are paying. So far, Americans are paying up. Although we heard from, I just give you an example, Procter & Gamble, they're worried that many of their loyal consumers, if prices keep going up, are going to look for substitutes, maybe a no-name brand, for example. We heard from PepsiCo. They reported about a week and a half ago. They said, no, we're doing okay. We passed along cost to the consumer, and they're paying it. At some point, that stops. Now, the other part of this is, by the way, is labor, because labor in most companies is the key input cost. And what we saw was that labor costs were climbing higher and higher, again, forcing companies to raise their prices. Right now, by the way, we're seeing a leveling off, and those higher wages, and the signing bonuses to work at McDonald's and so on. We're seeing that level off. We hope that stays. So the Fed, by raising rates, is trying to do what's seemingly impossible, but it's working, to slow down the economy. They feel that the more the economy slows down, the more that demand eases, where you say, hey, you know what? I'm not paying that. That's ridiculous. Then prices start to come down. That's the only thing they can do. They can't do anything about the containers, being shipped out of China if the ports are closed there. There's nothing they can do about that, but they can do enough to slow down the housing market. You slow down the housing market, you're slowing down furniture prices, lumber prices, and so on. That's what they want.
So consumers, families, as well as businesses, when it costs so much to borrow money, then the borrowing slows down, and therefore the spending slows down. Is that the concept? Yes,
exactly. And by the way, I just add, we came into this period, I call it post-COVID, with lots of money in the bank accounts. Right. It was one of the biggest, that also pushed inflation up. But what we're seeing now, and those of you who follow this, it's M2 money supply, That's starting to come down. And by coming down, it works with a lag. But what it's telling us is that infusion of capital, of money, is beginning to ease. And that's also good to try to wind down inflationary pressures.
So let's shift our discussion a little. We talked about what's kind of going on and how we got here. By the way, my wife Doris and I ordered a refrigerator. We have a refrigerator story too. 7 months, Quincy. 7 months. We're waiting for this thing, and Best Buy, I hope it's okay to mention that company. We deal with them a lot, but they kept telling us it's coming. And we finally got so frustrated. We had a guy in the store looked and said, well, no wonder you're not getting it. They quit making that thing like 8 months ago. You ordered refrigerators not even being made. We thought it was stuck on a boat somewhere, but wow. Everybody's feeling it with their own little personal stories about this supply chain and everything going on.
Let me just put one more thing in, because we said that this is my kitchen table discussion, right?
Right.
So we have a kitchen table. Remember, we moved from a very, very large house to a small one. We moved out of state. And so we have this kitchen table, and I needed 8 chairs. So in April, I ordered 8 chairs from a well-known store, right? A well-known store. So then they said, how about, Quincy, it's delayed August, right? Okay, I said August. Right now it's August. Okay, I'm getting it. So just yesterday, I got a message, and it said that it will not be available until April of 2023. I called up and I said, cancel the whole thing. I may not be breathing by then. Just forget. My husband won't even know what's coming at the door, what your wife ordered chairs. So there you go.
Everybody's going through this stuff. It's crazy.
Yes.
Well, looking to the future. So let me ask
okay.
you. And I've heard this, and you probably heard it too. But I've heard this thing. I want our listeners to hear that somebody once said that economic forecasting was created to make astrology look respectable. So the crystal ball. What do you think is happening overall? How is the second half of the year probably going to go?
Well, let me get my crystal ball. As somebody who, yes, I do have a doctorate in economics, but because I worked on a trading floor, worked on that side of the business, here's what I say. It's an expression that we all use. The market gets the news first, right? And then the market looks ahead. The market tends to look ahead 3 to 4 months. So it is interesting because the question is, how many more rate hikes and how high will they be? Will the Fed actually push us into a deeper recession? Because then you are going to have the stock market pull back a little bit more. But the bear market that we are in, the bear market does not necessarily mean a recession is coming. Everyone needs to know that. And also, if we do go into a deeper recession, sometimes they're over fairly quickly, that the Fed stops raising rates and then starts to lower rates. The market is going to sniff it out. By the way, we saw a tremendous rally last week. The Fed met. He said, you know what, we may have to go in with a large rate hike. I mean, he said we're going to be data dependent. Well, the market is data dependent too. So this is what we will be looking for to give us a hint. One, we're going to look to see whether or not we start to see the growth names come back. So let's say consumer discretionary names, which have really been beaten up. Folks, that just means all of the things we buy when we go out that we do. We don't have to have it, but we do. I still need my coffee from McDonald's. You could call that discretionary, but I consider it a consumer staple. But in any event,
gotta have that coffee.
But there's nothing better. There's nothing better than McDonald's when it's fresh and it's hot. Oh my goodness. So anyway, that's what we're looking for, but not just a one-day wonder. We're not, not as a trading play. What happens is we moved over to consumer staples. These are the things that we must have, right? What happens is the market will start shifting and move over to consumer discretionary. The market will shift over to, say, industrials. It will be all the things that got battered. Those will be signals to us that the market is looking ahead and seeing the end of this. And that's important. We keep our eye on those signals. We also, I should mention, we look for the strength in a market that's moving up. We call it escape velocity. I always think all of us in our business want to be astronauts. We use these terms. But what escape velocity means is that when the market turns, that you see a surge of buying. We always look for that. We look for the volume at the end of that day. We look for it over a 10-day period. So that is something we keep an eye on. It will tell us, regardless, by the way, of what the economic data are, it will tell us that the market is seeing a turn. And it's important. It's a process. But when it happens, and it always does happen, it means we're out of it. One other, and it has to do with the election coming up.
Right.
Historically, statistically, we see a kind of choppy period going into the election, whether it's the presidential or the congressional gubernatorial midterm elections. Yeah. Come the election, and we vote, and it's counted, and we know it's the over. Typically, the next 3 months are quite strong. They tend to be strong, by the way, even without the election. It's a certain seasonality. But with the election over, the market tends to do well for the next 3 months, and then actually even beyond that. And it usually is quite strong. So everything has to be in place. But what needs to be in place? We're already seeing it. The supply chain beginning to ease. Yes, you get your refrigerator, I'll buy other chairs. We'll all be living happily ever after, but it's happening. Uh-huh. It is happening, yes. And then you couple that with the slowdown in the economy, it will bring inflation down. You know something? We're even seeing food prices come down, which is good news. And it should be even better. We're looking to see that the Ukraine grain, because they're one of the most important breadbasket nations in the world. They typically sell to developing nations, poor nations. Mm-hmm. Just today, as we are speaking, they actually were able to get a shipment out for the first time since the war began. Wow. Under an agreement with Russia. Yes, it's heading over into Libya, but if they can keep going and there are no more bombs, which we hope, they will be able to get more grain out to other emerging markets where food is really necessary. There's a shortfall. Also, we're in the United States growing more. The price for wheat and corn actually down today. And that's good news. These are the kinds of things we look for to see that inflationary pressures are easing and moving in the right direction. That's going to help us for the second half of the year. Once the market feels that the Fed is how shall I say it, feels as though that they're meeting the move towards price stability.
Well, I'm feeling optimistic. I've been very upset paying. I think it's now like $3.65 for a dime cup of coffee, and I'm hoping that the price gets lower to a dime. I can buy a cup of coffee for a dime. I don't think the price will ever go down that far. But yeah, inflation is here. So let me ask you that. So it's like, I don't want to go into this definition of recession, but because it's like whatever Clinton said versus whatever Biden said. Anybody can spin it any way you want, but it is a fact, I think, and you're telling us that one of the balancing acts here, one of the dangers, is if the Fed raises interest rates, trying to slow down inflation too much, that stalls the economy, and then we go into a deep dive recession. Everything slows way down, where we could even have, you didn't say it, but even deflation is worse. Prices start dropping too quickly, and that causes a deep recession. Am I kind of saying that right?
Yeah, no, absolutely. One thing you left out was stagflation. So if you were to, which is really insidious. That's that you get inflation. The economy is really not growing. It's a nasty environment for consumers, but also for the stock market. There are a number of surveys with portfolio managers asking, okay, if you had to have one, inflation leading to stagflation or recession, which one? And actually, it's not a great choice, but they chose recession, because if you can expunge inflation, the market will see it. And we know, that we will come out of it. So that's, and you're right, the Fed is cognizant of that if they move too quickly, and remember, it works with a lag. Even when they stop, that last rate hike that they introduce is going to last in the economy for about 8-9 months. So they know that,
it affect things for 8 or 9 months. Yeah.
Yes, exactly. Yeah.
So it may be a little easier to define. Nobody's changed the definition, I don't think. The bear market, when the market goes down, is bear. When the market goes up, we call it bull. But the bear market, I think, is defined by 10% off of the high of the market. Is that what we're still saying a bear market is?
It's actually, maybe this is inflation. It's 20%. So it's 20%.
I'm sorry. Yeah. Correction was 10%. 20% is bear market.
Yeah. So it's from the top. But here's another interesting facet of this particular bear market. From February 2021 on, a good portion of the S&P 500 had come down quite markedly, almost to 20%. It wasn't until the big, what we call the generals, so those big names, those big tech names, when they started getting hit, that the S&P 500 came down 20%. So the question then becomes, do we count the ones that were down for a long time, or do we just have to say, okay, look, technically it started when it hit 20% down? I guess that's what we're going to stick with, that definition.
Well, so how far up does the upside have to go before people stop calling it a bear market, where it's not just a short time rally for a few days and it drops again? Is there a concept or trend, like it's no longer from the high, it's no longer 20%, it's only 15%, so we're not in a bear market anymore?
Well, yeah, no, absolutely, and that's what everyone's looking for. There've been days. A couple of weeks ago, we had a great rally. What we look for on the technical side, Jerry, is to see that 90% of the S&P 500 move quickly up, and to get technical, we say they need to move out of the 50-day moving average, and that's very technical, but it's something that we know from history, that when the market does that escape velocity and just surges ahead, it typically tells us that the bear is just about over.
And one thing, I think you and I chatted about it when we were saying hello or something last week to get to know each other, and we talked about is there a part of the recession, stagnation, all that? We're not going to have a problem like we did before with the credit, where anybody could fog a mirror and easy credit. And you told me something about your dog. What's your dog's name?
His name was, alas, Reginald von Crosby.
Oh my gosh. Okay. Reginald has passed, apparently.
Yes.
I'm sorry to hear that, but Reginald got a credit card or offered one or something. Could you tell that story? Could you?
Yeah, no, absolutely. And he wasn't alone. I have a feeling it came from a mailing list that was generated at the vet's office, right? Because they always, right? And so the next thing you know, he's getting credit cards. The next thing you know, he's getting offers for a mortgage. I wonder what kind of subprime mortgage he would have gotten. But as you said, when we talked about it, back then, all you need to do was show that you were, breathing, barely breathing, but just breathing enough. Mm-hmm. That is what did us in, is that proliferation of those subprime mortgages that then got sliced and diced and wound up in portfolios across the world, not just in America. And worse than that, they got levered up. So if I bet $1 to $1, then what I did was I would do $20 to one, $60 to one. Mm-hmm. The music stopped. The music stopped when Mr. and Mrs. Smith couldn't pay the mortgage. I mean, I know it sounds as simple as that, but that's what happened. Suddenly the economy turned back then, and those folks who got those subprime mortgages, first it was late payments, and then it was no payments. And then all of those products that were built around it. Imagine, I always described it this way. Those hot dogs that you got like at weddings? There's a hot dog, and then there's some pastry around it. And then sometimes they put a cherry on top or a piece of pineapple. Well, at the core of it is a hot dog. Well, guess what? We could get all fancy and complicated about what those subprime contracts were, but at the core was a mortgage. And when those mortgages weren't paid, everything exploded. The old game, the old maid game, you're looking for the old maid card. Mm-hmm. That's where we were. Who had this? Because we knew it was going to blow up. And it's exactly what happened. One investment bank after another, insurance company. It was terrible. And it created a huge amount of damage to confidence, damage with jobs in the economy. This time around, it's very different. We know what caused it. We know what we have to look for. We know what the Fed has to do. And the fact is that I think today, if my dear Reggie were alive, I don't think he would be able to get a mortgage. I'm not sure I'd get a mortgage anywhere, but he wouldn't get a mortgage, and he certainly wouldn't get any credit cards. But back then, we used to laugh, but we weren't alone. Everybody, we would at work, people say, "Gosh, it's getting crazy." But one thing we do know: when craziness goes on, and greed goes on, and risk gets rewarded on, it will end ugly. It will implode. It will implode. Yeah. Mm-hmm.
Well, I'm gonna see if I can get Ruby Joy, who goes to the vet a lot. I'm gonna inquire if we can get some kind of credit for her, just to see what happens.
Yes. Yeah. I hear you.
Well, Quincy, thank you so much. I'm looking at the clock here. I want to thank you for your insight and all your information, and I'm feeling uplifted and positive. Like this is going to end up in the right direction, and I want to thank you for sharing everything and with us, and thank you for the memory, Reggie. We've got everybody has lost refrigerators and lost kitchen chairs and lost pets also. So
yeah.
It was a good time talking with you today, and I want to thank you. Thank you very much for being with us.
I want to thank you so much. I enjoyed it, but I just want to end by telling everyone this too shall pass. Mm-hmm. And these great companies in our country, great companies, are on sale. And at some point you will be adding to your portfolio, and you'll look back at this time and say, it was a bad time, but it was a time that cleaned things out and allowed us to buy these great companies at a discount.
Definitely. It's something I've always taught people when I've taught classes and stuff, is to think about it. The stock market is the only thing on the face of the earth that when it's on sale, nobody wants to buy it. But it's time to buy. This will go up. This will go up hopefully very soon.
Yes.
Okay, well, thank you. Have a great day. And again, thank you for being with us.
Thank you, Jerry. Bye-bye.
Bye-bye. Well, as always, if you're enjoying this podcast, or if you have a topic you'd like us to review, let me know. Just send us an email to educatedinvestor@householdergroup.com. That's educatedinvestor@householdergroup.com. So this is Jerry Blakely. Again, thank you for being here. Onward and upward, as I always say. And we'll talk to you next time.
The opinions voiced on this show are for general information only and are not intended to provide specific advice or recommendations for any individuals, nor intended to be a substitute for specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risk, including possible loss of principal.